Understanding leaseholds, an essential guide to renting property. When engaging in any property transaction, understanding the terms and conditions surrounding lease agreements is critical. Whether for business or residential purposes, a leasehold represents a vital aspect of real estate management. This article will provide a comprehensive overview of leaseholds, including their types, implications, and related financial considerations. What is a leasehold? In accounting terms, a leasehold refers to an asset being leased, typically encompassing properties like buildings or spaces within buildings. The lessee, or tenant, enters into a contract with the lessor, or property owner, allowing them the right to use the property in exchange for a scheduled payment arrangement over a specified period. These agreements vary widely, but they commonly arise in commercial contexts, such as renting office spaces for corporate use or leasing retail spaces for businesses like restaurants and stores. Key takeaways about leaseholds. A leasehold is an accountable agreement where a lessee rents property from a lessor over a defined timeframe. Many businesses opt for leasehold arrangements instead of investing in constructing their own buildings. Lease contracts, especially in commercial arrangements, often encompass critical elements such as payment structures, breach of contract clauses, and terms regarding leasehold improvements. The framework of leasehold agreements. Every leasehold contract includes essential terms defining the rights and responsibilities of both parties involved. Important aspects typically outlined include duration, how long the lease runs, which can generally span from 1 to several years. Payment definitions, the structure of payments, including rent amount, due dates, and any possible escalation clauses. Breach of contract regulations, terms that specify actions resulting in potential contract termination. Leasehold improvement stipulations, responsibilities regarding any modifications made to the property. Leasehold improvements. Leasehold improvements refer to alterations made to a rental property by the tenant to suit their needs, which might include building partitions, updating lighting fixtures, or adding shelving. In most cases, the contract dictates financial responsibility for these improvements, whether by the tenant, the landlord, or a shared arrangement. While leasehold improvements enhance the utility of the leased space, they are classified as fixed assets on a company's balance sheet and are eligible for a depreciation schedule of 15 years, a requirement set forth by the IRS. Different types of leaseholds. Understanding the types of leaseholds is critical to knowing your rights and responsibilities as a lessee. Different types include 1. Tenancy for years. This form of leasehold is characterized by a specified beginning and end date. Contracts can range from a few days to several years and encompass clear terms regarding use and payment. 2. Periodic tenancy. This leasehold is characterized by an indefinite duration with renewal periods. Initially agreed upon for a defined time, like a year, it can automatically transition into monthly agreements, requiring notice for termination. 3. Tenancy at sufferance. In this case, a tenant remains in a property after the lease expires without the landlord's consent. If rent is accepted post-expiration, the lease may continue on a month-to-month basis. 4. Tenancy at will. Generally the most flexible arrangement, a tenancy at will can be terminated by either party at any time, not requiring a formal contract. Leasehold interest explained. A leasehold interest refers to the lessee's exclusive rights to possess and use a property for a specified period, differentiating from a freehold interest where the owner has total control and ownership over the property. Leasehold interests are common in scenarios like ground leases, where individuals may rent land for extended terms, e.g., 40 years, to develop properties. Leasehold recognition in retail. Retail businesses, notably brick-and-mortar stores like Best Buy, frequently rely on leasehold agreements. Best Buy, for example, leases most of its locations and undertakes leasehold improvements tailored to its design needs. Their leases often contain renewal options and clauses linked to revenue percentages, embodying typical practices in leasing among retailers. Frequently asked questions about leaseholds. What is a leasehold estate? A leasehold estate allows a tenant to use an owner's property for a specific time, backed by formal agreements detailing conditions of use and payments. How do you depreciate leasehold improvements? Despite the IRS not allowing the direct deduction of leasehold improvements, they comply with a depreciation timeline of 15 years based on their economic lifespan. Which leasehold has a definite begin and end date? Tenancy for years is the only type of lease that outlines a specific starting and ending date. The bottom line. Navigating the complexities of leaseholds is essential for both lessees and lessors. A leasehold agreement outlines the mutual rights and responsibilities governing the use of property and can influence financial decisions regarding commercial and residential endeavors. Understanding the intricacies of leasehold arrangements can lead to better investment strategies, budget management, and overall property utilization. As leasehold agreements continue to shape the real estate landscape, being informed about their various elements promises success and efficiency in property management and utilization.